So let us come to what we are here for today. Okay, the exchange rate has become very volatile in the last 1.5 years. We have seen exchange rates moving from 84, 85 to 90, 91. It almost touched 92. Okay, so a lot of volatility in the exchange rates. So we need to evaluate and understand how the dynamics of dollar INR has changed, what has happened that such a big change has happened, and how do I adapt and hedge smartly. Okay, how do I adapt and hedge smartly? Okay, so let us come to it one by one. What are we going to carry? We are going to invest about an hour on this, and we are going to look at multiple things. What are the first things what we are going to look at? The first thing that we are going to look at is what is the new ecosystem. Okay, what has happened in dollar INR that it has changed. Okay, earlier it was something different. Now it is very different. So first we need to understand what has happened and what is the difference. Okay, so understanding that is very important, because once you understand how the difference is or what is the thing that is different now, then you will be able to come to the next question as to how can I hedge smartly during such volatile times. And the way it looks like, it is very evident that this volatility is going to remain. Probably I will also give you indications how, why is that so, and why is that the volatility is going to remain. And then we'll also look at what are the smart key instruments, what are the real smart instruments that can be used to hedge my risk. All of us understand that there is a big amount of risk, and how do I use such instruments to mitigate the risk. And then finally we will invest some time in understanding that what is the most optimum and prudent strategy. Okay, so combination of forwards and options are the most optimum and prudent strategy. We'll come to that towards the end. And ladies and gentlemen, anytime if you have any queries, please feel free to write it out on the chat box. Okay, I will attend to all the questions one by one, whatever I get on the chat box. Okay, so now let's come to the first system, the first topic. What is the new ecosystem, and let's try and understand what that ecosystem is. Okay, now before I come to it, I want to show you, this is the long-term chart of dollar INR. Okay, this is from 2000 onwards till now, so it is like 25 and a half years of dollar INR. If you look at two phases, the first phase is from 2000 to 2007-8, when it was mostly sideways. You can look at the screen and it is very visible that initial 7-8 years was sideways, and after 2008-9 the prices have just shot up. It has gone higher, and it has gone substantially higher. So what is the conclusion? The conclusion is that in the last 10 to 15 years there has been a very consistent two-way volatility. Okay, even though there is a consistent rise in prices, there are very frequent bouts of two-way volatility. If you see the blue arrows, the prices are going higher, the dollar is going higher, rupee is weakening. And if you're looking at the others, if you're looking at the red arrows, then you can see that the prices are correcting. Okay, the prices are correcting. So we are looking at a lot of blue arrows where dollar is rising, rupee is weakening, and then we are looking at the red arrows where rupee is recovering and the dollar is declining. Okay, so very clear that the long-term uptrend is there, very clear and identified long-term uptrend, and that typically reflects the difference of interest rates between India and US, which on a long-term basis has been between 2-3 on the lower side and 5-6 on the higher side. Now, another very important conclusion is that the two-way volatility is normal. Okay, don't treat it as an exception. Understand that the two-way volatility is the norm. It is not the exception. But one thing what is important to understand is that there are longer periods of rupee weakness and smaller periods of rupee gain. Okay, and that is the reason why the prices are consistently going higher. Okay, so it is making higher highs and higher lows, longer periods of rupee weakness and smaller periods of rupee gains. Okay, so that is kind of a equal kind of a high risk situation for both exporters as well as importers. Now let's look at one more slide. Okay, this is also very important to understand whenever I am hedging. Okay, so there's something called a hedge cost. There's something called a forward premium. Remember, if you are wanting to hedge or take a forward cover or take an option, there is a time value, and that time value comes because of the difference of interest rates. And if I want to hedge, let's say after 1 month or 2 months or 3 months, then there is a forward premium attached to it. Okay. For exporters, it is a receivable forward premium, and for importers, it is a cost. Okay. So if you look at the hedge cost, which has been there for the last 20, 25 years, it has been there since the currency evolved. Okay. But what is really interesting is how the hedge cost has changed or has been volatile in the last 25 years. So if you look at the period prior to 2020, almost 20 years, from 2000 to 2020, and from 2020 till now. Okay, so I'm just trying to, divide this whole 25 years into two periods. First period of 20 years from 2000 to 2020, and the second period of just about 5.5 years from 20 onwards till now. Okay, so typically 6+ years. So if you look at this chart, the hedge cost in the initial 20 years, there has been a lot of volatility. There has been a lot of variance. Okay, it has even gone negative, but negative, all of us know, was an aberration. It was not the norm. It was not the standard. So usually the hedge cost has ranged between 2 to 6%. If you look at the majority of the period, it has been between 2 to 6.5%. Even though it has gone to 7-8%, but again gone up and then come down quickly. So majority period is between 2 to 6%, 6.5%. But if you look at in the last 5 years, okay, so in the last 5 years, that has changed significantly. And if you look at the forward premiums now or the hedge costs now, it is in between 1.5 to 3.5%. Okay, so that is a very, very big change. 1.5 to 3.5%, a very big change from what it was there in the first 20 years to the now last 5-6 years. So this is the first dynamic change that I wanted to tell all of you, that how the dollar INR ecosystem has changed. I will tell you about something more, but this is the first really big change, that the forward premiums or the hedge cost, which used to be 2, 3, 4, 5, 6%, 6, 7% sometime, is very low now. It is around 1.5 to 3.5%. Okay. Now let's come to another thing, some kind of a research that we did. Again, everything to suggest you and tell you as to how the ecosystem has changed. So a small research that we did for 25 years, we took a forward every working day. So that is the methodology I'm trying to tell you. We took a forward every working day for 3 months, 6 months, and 12 months. And we have been doing it for every working day, Monday to Friday. Every day, working day, we are taking 3 forwards. A forward for 3 months, 6 months, and 12 months. Now, at the end of 3 months, 6 months, and 12 months, I'm just evaluating what is the forward rate compared to the spot on that maturity of the forward rate. So it's a simple comparison between forward rate and spot at maturity. If I would have done a forward, what is the rate I get? And if I didn't do a forward, I didn't do anything at all, then what is the spot at maturity? Okay. And that performance of this evaluation, I have bucketed into 3 periods. The first period from 2000 to 2010, the second period from 11 to 20, 10 years bucket. And the third period is from 21 till now. Okay. Now, if you look at the first 10-year bucket, and remember that chart I showed you, initial 10 years, the prices were sideways. It did not move much at all. So in that case, what happened was the hedge cost, the premiums were very large. It was around 2.9, 2.7, 2.5. Look at this third column from the left, annualized premium in the first 10 years. It was between 2.5 to 3%. And the rupee weakening, spotted maturity is the currency moving in that period. So rupee weakening or the rupee change in 3, 6, 12 months was only 0.5%. Okay, so it was only 0.5%. while the premiums were significantly higher at 2.5 to 3%. So what does that mean? That simply means that if an exporter hedged, then he received 2.5, 3%, and the risk of rupee weakening was only 0.5%. And it was corollary for importers. So if importer hedged, so they had to pay very high premium, 2.5 to 3%, but the actual risk is very less. Okay, so this difference between annualized premium and the rupee change is what we call as the carry. Okay, it is called the carry. It's a financial market terminology, what we call as the carry. And carry is the ultimate benefit to the exporter who is hedging and to the importer who is not hedging. Okay, so in the first 10 years, the carry was very large, between 2 to 2.5%. If you look at 2011 to 20, 2011 to 20, this was the period where the two-way volatility started, okay, and rupee started weakening. So the carry reduced substantially. Okay, even though the premiums were very high, between 5.5 to 6%, okay, but rupee changed 5 to 5.5%. So carry, which was there by around 2 to 2.5% in the first 10 years, that reduced substantially and came less than 1%. Okay, so carry was anywhere between 0.5% to 1%, substantially lower than what it was in 2000 to 2010. Okay, now the real catch is what is the carry in the last 5-6 years. So if you look at the bottom table, the carry now is negative. Now what does that mean? That simply means that the premiums, annualized premiums, remember I showed you that chart, premiums are lower and rupee weakening is higher. Okay, so the carry has become completely negative. So this is the largest or the biggest change that has happened in the dollar INR ecosystem. Okay, I will just gradually outline what has happened in each of the 10 years. Okay, this will help us understand how the dynamics have changed and how it has changed substantially. Okay, so first 10 years, the past, okay, the first 10 years, 2000 to 2010, carry was substantially positive. Rupee depreciation was far lower than forward premiums. Okay, so exporters were hedging very regularly. They were keeping very high hedge ratios because they got a lot of forward premiums. Okay, but importers were very reluctant to hedge. They were not hedging at all, because if they hedged, then that is the premium that they have to pay, the hedge cost that they have to pay, and actual rupee weakening was quite less. Okay, so first 10 years, very big dynamics, very different dynamics than what it is now. Okay, so next 10 years, the carry remained positive. Remember, I told you 0.5 to 1%. The carry remained positive, but it had reduced substantially from the 2000 to 2010 period, where the carry was 2.5. Here in this 10 years, the carry was less than 1%. Okay, so the carry was significantly lower, less than 1%. Okay, so this was the period where you got the first indication that the market dynamics were changing. Okay, even though it had not flipped, the carry had not become negative until 2020-21, but it was the first period where the market participants like us got a feeler that the dynamics are changing. Okay, and it also led to a significant increase in the two-way volatility of dollar INR. Now, exporters who were hedging earlier, they continued to hedge. Okay, importers were suddenly waking up and were evaluating the two-way volatility. Okay, so sometimes they were losing money, sometimes they were making money. Earlier, from 2000 to 2010, they always made money by not hedging. But in this 10 years, they tasted both. They tasted success, they tasted failure. Okay, so now they were gradually starting to wake up as to that they cannot continue the unhedged position which they were carrying in the first 10 years. Okay, so that is the past. The first bucket of 10 years, how it was, the second bucket of 10 years, how it was, and now let us look at the current scenario. The current scenario where the dynamics have dramatically changed or the dynamics have flipped. Okay, now here the carry has turned negative. We have seen in that table, if you want, I can get that table back. We have seen in this table, the last table at the bottom. See, the rupee change or rupee weakening, annualized rupee weakening from 2021 till now is about 3.5 to 4%, while the forward premium is between 2.75 to 3.15, 3.2%. So the weakening is far more than the forward premiums, and hence the carry has suddenly become negative. Okay, so this the latest 5-6 years where the weakening has been far more than the forward premiums. Okay, now exporters who were hedging earlier, they have suddenly realized that by doing forwards, they are not making money, or they are in fact losing money, because by doing a forward, they are getting a forward premium of 2.5%, but rupee is weakening 3.5 to 4%. So all their forwards are going to get out of the money, or all their forwards are ending up as loss making. Okay, importers who have not hedged earlier suddenly are realizing that rupee has weakened too much. What they had costed at 84.85, they are paying at 87.88. What they are costed at 87.88, they are paying at 90.91. Okay, so both exporters as well as importers are heavily disturbed, or I would say the processes or hedging strategies that they were, following for many years, everything had to be changed. Okay, everything had to be changed. The entire ecosystem of export hedging and import hedging had to be revamped, and it had to be changed. Okay, so two-way volatility came in, and now both the exporters as well as importers are waking up to the need of a proactive hedging strategy. You cannot be passive the way they were in from 2000 to 2020. Exporters were blindly hedging, importers were not hedging. So that was a very passive or a sleepy kind of a strategy. But now, because there is substantial two-way volatility, exporters who were hedging, they are going out of the money. Okay, can't hedge anymore, but they can't keep unhedged positions also. Importers who had never hedged now are waking up that rupee depreciation is happening far faster than they had earlier envisaged. Okay, so bottom line, both exporters and the importers, both the community are now getting extremely disturbed and extremely panicky in terms of how to hedge, how what instrument to take to hedge, because they have realized that being passive is not going to help anymore. The market dynamics have dramatically changed. Okay, so that is covering the first aspect of our presentation today. Okay, what are the changing dynamics of $INR? Okay, now there is one more very significant development that has happened in the last 1.5 years, and that is very critical for $INR because it directly relates to the effect on the exchange rate. Okay, because if the governor would not have changed, then probably we would not have seen this kind of volatility. Okay, now what is the change? Okay, now the change is this governor and his entire team and the ideology at the Reserve Bank is that they need to have minimal interventions in the forex markets. Okay, they are firmly of the belief that it is a financial market. There are demand supply mechanisms. If there are market forces, let the market forces determine the price. Let the price discovery be through the market forces. And let the price discovery not be driven by RBI interventions or by RBI actions. Okay, ladies and gentlemen, this is a very, very big change, because prior to Sanjay Malhotra, we had Shaktikanta Das, and Shaktikanta Das had a very clear-cut strategy or a very clear-cut objective of keeping exchange rate volatility to the lowest. Okay, so he had all the processes and all the systems in place in the dollar INR market to keep the dollar INR volatility as low as possible. Okay, so from that scenario, from that regime, from that era of very subdued dollar INR volatility, primarily because the central bank acted in such a way to reduce the volatility. But now we have a new governor. He came in I'll just show you. He came on 11th of December 24, just slightly more than a year back. Okay. So very clearly you can look at this chart and you can look at the vertical line. Vertical line is the period where on the left side of the vertical line, you have the Shaktikanta Das era, and on the right side of the vertical line, you have the Sanjay Malhotra regime. Okay, and we can see it so very clearly, the effect of the change in ideology, the change in actions. Okay, prior to 11 December 24, if you see, the exchange rate volatility was narrowing. Okay, the price bands were narrowing, and because obviously very clear cut guideline, suppress the volatility as much as possible. And now see what happens after the new governor came in December 24. See how the prices started behaving abnormally, or I would say started behaving normally, because of the demand supply forces, because of the demand supply mechanics. Okay, initially in Jan Feb and middle of March, Jan Feb probably, rupee suddenly weakened from 85 to 88. Then rupee suddenly gained from 88 to almost 84, below 84. And then from 84 onwards, May, June onwards, sorry, from 84 onwards, we have seen a continuous, rapid, quick rupee weakening. Okay, so that directly follows the change in regime, and that directly follows the actions that this current governor with his team wants to take as far as exchange rate volatility is concerned. Okay, so this is also a very, very big change, and what it probably tells us for the future is that as long as this regime is going to be there, Sanjay Malhotra is going to be there at least for 3 years. So just 1 year done, so 1.5 to 2 years left. So as long as he is there, we will see a lot of volatility in dollar INR, and we will see a lot of two-way volatility in dollar INR. All of us has seen how Trump had imposed tariff on Indian exports to US, then he reduced. Okay, when he imposed, then rupee weakened. When he reduced, then rupee gained a bit. Okay, but these are all, short-term to medium-term changes. Ultimate change is that interventions will be lower. There will be demand supply gaps. Demand supply and market forces will determine the exchange rate. And since market forces, demand supply, all these mechanics are volatile, ultimately the exchange rate is going to remain volatile. Okay. So stability that we had seen and experienced during Shaktikanta Das, that stability is not going to come back so quickly. Okay, so very contrasting phases of RBI leadership, and because of that is the result that we are seeing such high two-way volatility in dollar INR. And as I said, going ahead, it looks like these kind of two-way volatility is going to remain. Okay, why I'm saying it again and again is I speak to a lot of large companies in India, and a lot of treasurers and a lot of CFOs of large companies, directors of large companies keep telling me, Mr. Victor, this volatility is short term, rupee will become stable. Volatility is short term to medium term, rupee will ultimately become stable. And I keep telling them that, sir, we are in a very dynamic world. It is very, very unlikely that rupee is going to remain stable. It is going to be volatile, and we are going to see very significant amount of two-way volatility. Okay. Now, very important, we have understood how the dynamics were earlier. We have understood how the dynamics have changed. The forward premiums have changed. The RBI governor has changed. So the entire dynamics and mechanics of the market has changed. Okay. Now, what does this change mean? The first change, as I just said, large two-way volatility. Okay. Demand supply will drive. So sometimes demand will be higher, sometimes supply will be higher. So we will see rupee gaining. We will also see rupee weakening. Okay. And economic fundamentals and capital flows will drive the exchange rate. Demand supply will drive exchange rate. Okay. So increased volatility is the other conclusion. We will see more volatile market, and we will very likely see, we might see stable periods. It's not that it's going to be volatile always, but it will remain volatile most of the time. Okay, there will be some degree of stability as it is stable now. Last 6-7 trading sessions, what we have seen, dollar-INR has been stable around 90.50. Okay, but going ahead, it looks like the period of stability is going to be smaller, and we are going to see more and more or longer periods of larger volatility. So by doing a forward, there will be a spot price, which is the current price. And since you're going to do a forward for the future, 1 month, 2 month, 3 month, 4 month, you're going to do it for the future, you will fix the rate. Okay. The rate will get fixed, and it will be spot plus the premium. Okay. I got a question, but I will answer. Let me just complete the PPT. Probably later part of my PPT will help you in probably answering the question. But ladies and gentlemen, be rest assured, please type in your questions on the chat box. I will have a look, and I will answer each and every question. I see a question on euro. I will certainly answer the question on euro as well. But please allow me, ladies and gentlemen, it's just about 3, 4, 5 slides left. Let me finish the slides, then I'll come back to the questions one by one. Okay. So we are talking about forward. So forwards is like a pure protection. Okay, you are hedging it for 1 month, 2 months, 3 months. You can hedge it for 12 months. You can hedge it for 1, 2, 3 years. Long-term forwards also you can do. But typically, companies hedge for anywhere from 1 week to 1 year. Okay, so in a forward, you just have a spot. You have forward premium. You lock in a particular rate. So it is pure protection. Okay, so if you want absolute certainty in price, irrespective of wherever the market goes, if you want absolute certainty in price, then forwards is a very simple instrument to hedge. Okay, but there is a catch. What is the catch? Forward. The catch is okay. Sorry, I think just allow me a second. Okay, sorry for the interruption. So what is the catch in forwards? The forward problem with forward is the opportunity loss. Okay, the opportunity loss in the sense that if market goes in your favor, if let's say you are an exporter, I'll explain both. If you're an exporter, let's say you have taken a forward, 90 is the rate now, forward with forward premium, 91 is the forward rate for 3-4 months later, and 4 months later the market is 92. Okay, so you will see that the forward is loss making because you are getting 91 when the market is 92. Okay, so the upside capture for an exporter is not there on forward. Similarly, for an importer, if you hedge at 90 and I get 91, but during the payment time, the market comes down and goes to like 89 or 90, then you have a loss. Okay, so forward limits that. Okay, the forward fixes the price. It doesn't give you, flexibility to capture favorable market moves. Okay, so the basic question is, if it has a benefit and it has a risk, then what is the time to deploy forwards? Forwards can be deployed when your cash flow timing is certain and you want margin protection at all costs, and then obviously you don't want to incur any cost of a hedge, because I will talk about options, and options comes with a cost. So I am perfectly fine with the forward rate, irrespective of wherever the market is going. I am perfectly fine with the forward rate. If you want that kind of certainty and you're not looking at capitalizing on favorable market moves of the future, then forwards can be deployed. Okay, but in such volatile times, whenever there is so much of two-way volatility, is forwards the most appropriate instrument? Is the leads to the next question, what we call as the smart alternative, where you can take a vanilla option. Okay, so in a vanilla option, you get protection and you get participation as well. Okay, but this protection and participation, the benefit of both the worlds, the best of both the worlds, that will come at a cost, and that cost is called option premium. Exporters can buy put options, pay an option premium. Importers can buy call options and pay an option premium. And once you have paid that option premium, you will get unlimited benefit if the market goes in your favor. So option premium will have a fixed cost and the benefit is unlimited. Let's take in case of the exporter 90 to 91, you buy a put at 91 and let's say pay about 40, 50, 50, 60 paisa of premium and option premium. And then even if the market was to 92, 93, 94, you will get unlimited participation. Similarly, if you take for an importer, you buy a call at 91, you pay 50, 60 paisa. Even if it goes higher, you are protected at 91. Even if rupee gains and goes to 88, 89, you have the flexibility of letting the options expire and participating in a stronger rupee. Okay, so option is the really, really smart alternative, smart instrument. It will give you the protection it needs, and it will also give you participation in case the market moves in your favor. So that is why we say it, that you get the best of both the worlds, but that benefit of best of both the worlds come with a certain cost. Okay, comes with a certain cost. So what are the optimal cases for options? It can be used when the times are very uncertain. Okay, and very easy to answer. All times are uncertain times. Okay, so when market moves are very unpredictable, which it is almost every time, and your upside participation is important and it is strategically important, then vanilla options are the most optimum risk management instrument. Okay, but we need to learn to digest that option premium cost. Okay, we need to learn to understand that markets are too volatile and I need to use vanilla options to hedge. And I want all of you to apply your minds, okay, think about it as to what is the most prudent strategy or what is the most optimum strategy. Okay, I told you how the dynamics have changed, and I have also told you that how the dynamics have changed substantially and they have changed significantly. And the way it looks like, this change is going to continue and the markets are going to remain dynamic. So we will have more periods of large volatility and smaller periods of stability. Okay, then I told about forwards, then I told about vanilla options. Now, what is the most prudent strategy or the best way to manage my forex risk is through diversifying. Okay, so that is why we call risk diversification is the most optimum or the most prudent strategy. And what does risk diversification mean? Risk diversification simply means that you do forwards and vanilla options both. Okay. Unfortunately, in our country, whenever I have approached industry associations, large treasuries, large organizations, big exporter importers, and I suggest them to do vanilla options, they end up comparing vanilla options with forwards. Okay, it is A versus B. It is forwards versus vanilla options. I will either do a forward or I will do a vanilla option. Okay, actually, that or should be Hindi or rather than English or. आप forwards भी करो और options भी करो. So the most optimum strategy is not forwards versus options. It is forwards plus options. Okay. And it is not my intelligence. This is what I have seen very large companies, global treasuries doing regularly. Okay. So it is always a optimum combination of forwards plus vanilla options. Forwards will give you protection, full protection, no upside capture. Vanilla options will give you protection, but it will also give you, opportunities to benefit if the market moves in your favor. Okay, so both you have, so vanilla plus forwards give you a lot of protection, and vanillas will give you upside capture. Okay, so let's take, I do, for example, just the ballpark example. Let's take, I do 30% forwards and 30% options, or let's say 33% forwards and 33% options, and I keep 33% unhedged. So effectively 65 to 67% I have hedged. Okay, I have downside protection. 33 plus 33 open, I have full benefit if the market goes in my favor. Okay, if the market goes against me, I have risk of only 33%. Okay, see how the protection is much higher and the risk is much lower. Okay, so that is the beauty, and that is the best part about having a combination of forwards plus options. It will give you protection, it will be flexible, and at the same time it will also give you a decent amount of market capture if the market goes in your favor. And at the same time, since you are doing far lesser portion of options compared to your overall portfolio, the cost is also under control. You are not paying an exorbitant cost, or you're not paying a very high option premium cost. If you end up saying that, okay, vanilla options are the best instruments, which they are in one way or the other, they are the best instrument, but doing 100% vanilla options, there is a huge cost element involved. Okay, I end up paying a lot of option premium. Okay, so having 100% vanilla option strategy is a very expensive strategy. A lot of corporates will not be able to digest it. And that is the reason we suggest that do some portion of forwards, which is like free, you don't have a cost, but doesn't give you benefit, but give certain amount or probably a similar allocation to vanilla options, so that it protects you, and at the same time, it gives you the benefit if the market moves in your favor. Okay, so for both exporters and importers, in current scenario, what you can do is exporters, since rupee is continuously weakening, there is no point doing too much of forwards, because if you keep doing forwards, rupee weakening is getting more than the forward premium. Okay, so markets at your maturity dates is tending to be higher than your forward rates. Okay, so no point in doing too much of forwards. So have some forwards, smaller amount, probably 15, 20%, 25% of forwards, but at least have 25 to 30% of options. Okay, so even if you, all dollar exporters, even if you have 25% forwards, 25% options, and 50% open, then your downside protection is 50% and upside benefit is 75%, which is like fantastic. Okay, similarly, you can provide or you can structure some kind of a risk policy, risk system for importers. Now, we have seen rupee weakening consistently. So here for importers, you should have a higher allocation for forwards, because I am paying a lower forward premium and the risk of rupee weakening is higher. Okay, so forwards will provide you adequate protection. But what if rupee gains? Now we have seen that there are two-way volatility. So what if rupee gains? So to benefit from that rupee gaining scenario, it is better that you do some kind of vanilla options as well. Okay. So all dollar exporters and dollar importers on this slide, I have given on the right side. If you see dollar exporters, I've given a guideline. Dollar importers, I've given a guideline. Okay. So all dollar exporters and importers, please follow this, and I'm sure it will help you out. Obviously, it is not a strategy that you make and forget for 20 years. You prepare a strategy, run it for 1 year, review it, evaluate it, observe what has been good about it, observe what has been bad about it, learn from it, change it, modify it depending upon the changing market conditions. Okay, but basic bottom line, if you are following a risk strategy which is 20 years old, then probably the strategy is not doing very well. Okay, so that is the final slide, the final conclusion of what we have invested about 45-50 minutes, that you need to do some kind of an optimum mix of forwards and options, both forwards and options, some proportion. What proportion, what percentage is your choice. It depends upon your risk appetite. Okay, how much of option premiums you can pay. But remember one thing, we have to start learning to pay option premiums, or else if we completely depend upon forwards, then we end up paying far more in future. Okay, so if you pay option premiums upfront, you have a fixed cost that I have paid, and my limit and my benefit is unlimited. But if you don't do options and only do forwards, then you don't know what is the future probable loss that you can. So it is loss that you can get. So it is a completely unknown devil. And I'm sure all of us understand that unknown devil is far better than an unknown devil. Okay, so final words, take an optimum mix of forwards plus vanilla options. That is the future, that is the way ahead. And obviously, if future changes, then we will revamp, review, and change the strategy. Okay, so that is it from my side. So we come to the final quiz. I will not ask more questions than this. I'm sure all of you must be really fed up. Mr. Victor is asking just too many questions instead of answering them. But be rest assured, after this quiz, I will answer your questions. Okay, so the final question is a very simple. What defines a very prudent $INR hedge strategy today? Right in front of you, 4 options, A, B, C, D. Okay, so all of you, please respond. All of you, please respond. What defines a prudent risk management $INR hedging strategy today? Okay, so I am getting my responses. Thank you so much, ladies and gentlemen. Please keep responding. Please keep responding. And I'll be more than happy to get as many as I can. Okay, thank you so much. Now, the first question is the net import-export exposure booking is better, or booking import-export separately booking is the right way? Okay, good question. So the question is, for the benefit of everyone, what the person is saying, Mr. Sanjay is asking, is netting of export-import better, or is it better to book imports and exports separately? Okay. Now, Mr. Sanjay, netting can be done if exports and imports are in the same currency. First assumption, very big criteria, if they are in the same currency. Second, if the cash inflows of dollar and cash outflows of dollar are in the similar periods. Okay. Now, what does that mean? That means that if I get regular import payables, that cycle should match my export receivables. Okay, so I keep getting dollars and I keep paying dollars. If that is the situation, then netting of export imports is preferable. It will save a lot of your headache. It will save a lot of your transaction costs. But you need to open an EEFC account, Export Earners Foreign Currency account, which is an absolute must for netting. Okay, but if your export and import currencies are different, then obviously you cannot do any kind of netting. But if they are same, export import are same, and the payables and receivable cycles are similar, then you can use a EFC account and do the netting very efficiently, very easily. Remember, whenever you are parking funds in EFC account, you cannot park that dollar funds forever. Okay, there is a mandatory conversion time as per the current RBI regulations. So you have to be mindful of that as well. Okay, so it can be done provided certain conditions are met. If the conditions are met, then it can be done. I have seen a lot of exporters, importers very efficiently using their EFC account for similar currency receivables and payables. Okay, but I have seen a lot of companies not able to do it because their exports are in dollar and imports are in euro. Okay, so there is a currency mismatch. So if the currency mismatch is there, then netting is not very efficient. Okay, now what are your views on Euro INR and Euro? How does it? Okay, 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 good. So the question is on Euro. Okay, to all of you, ladies and gentlemen, whoever has Euro exposures, please understand that Euro, the way it has gone up in the last 1 year or so, it has not gone up on economic strength. It has gone up on a strategy to attempt to make dollar weak, and that was followed by Trump as soon as he was sworn president. He had deliberately taken certain decisions to weaken the dollar, and it's very simple correlation. If dollar weakens, all the other currencies gain. Euro gained, pound gained, Swiss franc gained, Australian dollar gained. So all currencies have gained. Okay, but if you look at economic performance, I think US is doing better than Eurozone. So typically, if you look at plain fundamental factors, then dollar should have risen, which it has not. Okay. Now that is what has happened in the past. So what is the future? The way it looks like, Trump is going to continue with his weak dollar policy. He says something else, he does something else. He says that he follows a strong dollar policy, but he takes all actions to weaken the dollar. Okay, so I think that weak dollar actions that Trump is taking is going to continue for a while. I do not feel that euro is going to decline anytime very soon. Okay, again, ladies and gentlemen, it is my view. Okay, looking at the fundamental and technical factors, I might be right, I might be wrong, but the bottom line is follow your risk policy. If you have euro exports or imports, it is absolutely mandatory that you have some kind of a risk system, risk policy. It is a very brutal currency. JPY, Euro, Pound, Australian dollar, Canadian dollar, Swiss franc, all these currencies are far, far brutal. Okay, so you need to look at managing risk efficiently. My personal view, I don't think euro is going to decline too much. Euro might have small declines, but I think ultimately euro will rise. Trump is looking to reduce interest rates in US. That is going to weaken the dollar. Okay, so that is on euro. Okay, what are your views on collar range? Okay, so collar range, Mr. Ranki Sataria, you should certainly talk to us. Please take down this name. We want to connect with him. Okay, if you are asking for a collar, then obviously you are looking at a derivative. You are looking at a structured derivative. Okay, so for a structured derivative, the level of understanding is very different. You have to buy an option, you have to sell an option. Okay, so there are complexities, and there is a lot of opaqueness. Banks will never give you a correct price. So, but answering your question, I think collar ranges are going to be very difficult during current times, because collar ranges are effective when the prices are moving in a range. Okay, but if the prices are continuously going higher, as I showed you in the chart, okay, all of us come back to this chart. Please look at this chart. If you look at the latest 6-8 months or 1 year or so, 1.5 years or so, we have seen a continuous uptrend. Okay, so the prices are not in a range, the prices are rising. Okay, but in a collar, you get a benefit if prices are in a range. Okay, you do not get benefit if the prices are in a upward moving trajectory. Okay, so in current scenario, when I am looking at a consistent weakening of the rupee, then I think collar ranges are not going to be very effective. Collar ranges can be effective when the prices are expected to move in a range and not in a upward sloping or a downward sloping trajectories. Okay, now another question: shifting some transaction from dollar to euro can provide real benefits. Okay, Mr. Manoj, this is not typically a forex question, but I'll answer for the limited understanding that I have. See, if you have shifted, if you are wanting to shift from one currency to the other, then obviously it is a buyer-seller agreement. The buyer may quote a price, he might ask for a discount, the product price will change. Okay, all those things. The economic and business aspect you have to look at. Okay, but if you are moving purely from a forex perspective, then you have to look at many things. Remember, euro is a far more volatile currency than dollar. Euro INR will have two pairs, two risk, euro dollar and dollar INR risk. Dollar INR will only have one risk. Okay, so from a risk perspective, keeping at dollar is beneficial. Okay, but from a risk perspective, euro is far more riskier than dollar. Okay, so that aspect you need to understand very well. But if the cost economics work, okay, the business part works, then I don't think there should be too much of a problem in shifting. A lot of companies do it. I've seen a lot of companies moving from dollar to euro export side, because they have euro imports. Okay, so they want to nullify the risk in their entire system. Okay, so if that is the objective, then you can do it. If that is not the objective, then understand that if I'm shifting from one currency to the other, how does the risk mechanics change, and is it really benefiting me in terms of getting the right product price? Because ultimately what matters is you are selling products or services, or you are buying products or services. Ultimately, how is the cost economics working there is what you need to put your mind upon, rather than trying to capture exchange rate volatility. Now, a lot of people might ask that now euro is beneficial. Again, sir, you are not doing business only for now or 6 months or 1 year. You are doing business for on a continuous basis. You will do business for years. Okay. So benefit for 1 year, is it too risky forever? That is the call that you will have to take. Okay. But again, I think, Mr. Agnihotri, we will connect with you and try and explore how our synergies can work. So, ladies and gentlemen, we have come to the end. If you have any more questions, please feel free to put it up on the chat box. The time is up, but we can still have time for learning and exploring. If there are no questions, I can come to the poll. I will just, okay. Thank you, ladies and gentlemen. Thank you for your time. I hope you have learned something. I hope your minds are working and you can apply that learning and come out with something good for the benefit of your company, for the benefit of reducing risk. Any more questions are there? Are there any more questions? Okay, thank you, Sanjay ji. Whether vanilla option can be used for making? Yes, vanilla option can be used for both exports and imports. Exports, vanilla option is called a dollar put, and for imports, vanilla option is called a dollar call. Okay, but one thing, Sanjay ji, please understand options very well before doing it, and obviously we can help you with that. It is a very beautiful instrument. Globally, everyone is using it. India has been quite late, but now people are realizing that we need to do this. Okay. So, Sanjay ji will probably connect and try and explore how we can help you in utilizing vanilla options to hedge. Okay. So, that is it from my side, ladies and gentlemen. Thank you so much. It was a real pleasure to share insights and knowledge, whatever I have learned over so many years of time. You can reach out to us. You can reach out to us, our help desk, either through mails or through whichever way, WhatsApp. You can reach out to us. Any queries on foreign exchange, forex, we are always ready to help. Okay. So thank you so much, ladies and gentlemen. All of you have a great evening ahead. God bless. Take care. Bye bye.